Are you wondering what's ahead for property in 2023? Maybe you'd like to know what other Australian property investors plan to do. Well, that's exactly what we're going to discuss in today's show as we unpack the results of this year's Property Investment Sentiment Survey. You'll hear what around 1,900 other Australians feel about the current real estate markets and what they plan to do. And you'll also hear how rising interest rates and inflation are affecting their household budgets and what that's going to mean for their property plans and how, if at all, they've changed their strategy. You see, these Aussies took part in this year's Property Investment Sentiment Survey run by my Property Update newsletter in conjunction with finder.com.au. And I think you're going to find the findings eye-opening. I know I did, especially when I read about how many investors sold up last year and the reasons why they did. Even more curious is how many investors are planning to sell up their properties in the coming year. And as usual, I'll share my mindset message with you because if you can change your way of thinking, you can change your life. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
How have rising inflation and rising interest rates affected you? Have you had to change your lifestyle? Have you sold a property or are you considering selling because of rising interest rates? Have the current economic conditions changed your strategy or your approach to property investing? Now, these are some of the questions we asked over 1,900 Australian property investors and would-be investors in our annual property investment survey conducted together with finder.com.au. And some of the answers are enlightening. Now, we've been running this survey since 2011, so it offers a rich and vibrant insight into how property consumer trends and sentiments have changed over time. And to walk through these with me today is Sarah Megginson, money expert from finder.com.au. Hi, Sarah.
Hello, thank you for having me here.
Well, it's been a year since we ran our annual Property Investment Sentiment Survey, and boy, what a year it's been for our economy and our property markets. Now, most of the respondents of last year's survey, 12 months ago, were very positive about the outlook for property markets in 2022. But they didn't foresee the war in Ukraine, rising inflation, rising interest rates, the fastest rise in interest rates we've had for 30 years. So it was really interesting to see the change in market sentiment. So, Sarah, before we go into what people felt like, let's have a look at who responded to the survey.
Yes, I mean, I can remember doing this with you many years ago. It's an incredible survey because there's so many years of data behind it, which allows us to see some really interesting trends. But this year we had around 1,900 people respond, and it's interesting to see how rising interest rates and inflation are starting to affect people, and also interesting to see how it's not affecting some people. I mean, investors in some respects are a little bit, what do you say? Not immune from these things, but they plan a little bit more, or I guess they're more accustomed to the rise and fall in property markets. They're not as caught unawares or caught off guard by volatility and interest rates. And, I was just talking to a mortgage broker yesterday and we were talking about the fact that interest rates are now back to where they were pre-COVID, or they're just a little nudge above it. But, that was only a couple of years ago that was quite a normal interest rate and most people were not under too much stress paying that. But now when you compare it to what we were paying during the pandemic, it does feel like a really big leap. So, yeah, it's very interesting, so much volatility. And yeah, I'm excited to kind of unpack some of the results with you and see where people are, where they're most stressed and where they see the biggest opportunities are.
So you're right, Sarah, but there's this thing called recency bias where people remember things closer to them than in the past. So we were really happy when money was being given away virtually at very low interest rates, but we'd forgotten that only a couple of years ago we were really happy with the interest rates we had then and we survived very nicely. So when we looked at who answered this survey, there was a wide range of respondents, which means it's a good indication of how the market feels. For example, about a third of people didn't own an investment property. 21% owned one property, 15% owned two, 11% owned three. So that's actually more than the average property investor, because we know 92% of investors never get past two investment properties. So it was already skewed to subscribers of Property Update and people who follow finder.com.au and have the Finder app. So they're already money savvy. And interestingly, 3% owned 10 or more properties. And some people earned less than $50,000, while 30% of respondents earned more than $200,000 as combined family income. But one of the things that I took out of it was that they took a long-term view. 45% of them were investing for long-term capital growth rather than cash flow. And many were looking for a property with potential to add value rather than just waiting for the market to do the heavy lifting, Sarah.
Yeah, and I think the really interesting thing there too, and we'll dig into the numbers in a moment, but is the fact that a lot of people actually sold over the last 12 months. I think it was 1 in 3 said that they've sold last 12 months, which, for some of them would have represented a really good opportunity to sell because the market was peaking. And if that suited your strategy to sell last year, you'd certainly be getting a better return than if you sold this year or next year. So it's really interesting to see what is driving people's decisions too. And that long-term view is so important with property. When I first started in property 20 years ago, you really could buy, flip, sell. In fact, I did that first few. I bought them and I renovated really quickly and sold them and made a quick profit. Those types of strategies are so difficult to go with now because there's just the entry prices are so high. The stamp duty and the lender's mortgage insurance, the real estate commission when you sell, all of that adds such a massive premium now that those real quick turnaround strategies don't work. So it is really encouraging to see that people, or the majority of people, are taking a long-term view.
Yes, they are. But that point of 1 in 3, 31% who owned an investment property sold at least one last year, and around 32% are considering selling in the next year or two, concerned me. Now, we saw that because at Metropole we manage close to $2 billion worth of assets for clients in Melbourne, Sydney and Brisbane. And they were selling up, and they'd ring the property manager and say, hey, the local estate agents tapped me on the shoulder. They've rung me. They say they've got a buyer for me and I've listed my property. Hey, don't you want to actually talk about this? No. I've got a buyer. And the property did exactly what they wanted it to do. It had gone up in value, but they were lured. So it wasn't part of a plan for a lot of people that we came across. It was really more taking advantage of an opportunity, but what are they going to do with their money? And then they've got to pay capital gains tax. Having said that, despite the barrage of negative media, 57% believed it's still a good time to invest. But Sarah, this was down from the strong sentiment of maybe 3/4 of people last year thinking it was a good time to invest.
Which is actually really interesting because last year was possibly not the best time to invest. A rising market, a booming market is not a great time to buy an asset. But, overall, the right time to buy a property is kind of what's happening in the market is secondary to what's happening with you personally. Obviously you don't want to buy at the peak of the market if you can avoid it. You always want to pay the least amount possible for a property if you can. But if you're having that long-term view, it's more about looking at where you want to be in 20 years. And if I'm 40 years old, in 20 years I'll be 60 and I have some goals for what I would like in terms of my wealth by then. And if I was to look back from 60 and look back at now, whether I bought a property in 2019 or 2020, 21, 22, 23, all of these years, there'll be a different entry point. The price that I pay will be slightly different. But the bottom line is if I own it in 20 years, it's going to be worth a ton more than it is today. So it's that long-term view that really matters the most.
Very much so. And I guess that all that's got to do with putting a plan together. So when we asked them, do you believe is now a good time to invest? Respondents were concerned about the current economic conditions. And sure, the percentage of who thought it was a good idea is dropped, but that's always the case. Most people are most confident close to the peak of the market and least confident at these sort of times when there are lots of signs, Sarah, that we haven't reached the bottom yet, but the market's looking for a floor and it's not a bad time to get into the market. We've really got to go back to 2018 to find similar levels of negative sentiment in 2017. But if you go back then, that's when APRA was tightening the screws. We had the Haynes Royal Commission. It was difficult to get finance. But boy, anybody who bought a property then when negative sentiment abounded, look where they are today.
Exactly. And it was so much tougher to get finance back then, particularly for investors. Interest rates, there was a really big buffer between investment rates and principal interest rates back then, I can remember. But yeah, this one is always really interesting. This is it a good time kind of sentiment around that, I think, because I think it is really important to be prudent and to think about how the current cost of living, pressures do impact your budget. For some investors, particularly those ones, who have a good high six-figure income and you've got that financial buffer to sustain you, then this cost of living crisis is not so much of a crisis to you. It's something that you can withstand. You'd prefer not to pay too much, but it's quite manageable. For other people who are probably, starting out as investors or they don't have as much of a financial buffer, I think it's a really good idea to consider what impact these rising interest rates are going to have on your budget. So I can understand this sentiment changing. And in fact, I was talking to an investor just a couple of weeks ago, and they said from the beginning of this year to now, these rising interest rates have increased their mortgage repayments by $69,000 overall. They had 6 properties, and they said overall over 12 months, if they extrapolated it out, an extra $70,000. They're obviously rents are rising, so they'll get a little bit of that back or offset there. But, for investors who are quite leveraged and quite heavily to property, this can be quite stressful with interest rates rising. So I can understand why there is a certain segment of the market that is either not planning to add to their portfolio or they're planning to sell. But I also really do think this is such a good opportunity. I think in the future, we'll look back at 2023 in particular as quite a good time to buy. And it's certainly, I will be looking at the market next year, that's for sure.
I agree with what you're saying. So part of it is the cost of properties or holding your property, but the other is actually the outlook, what they think is going to happen to property values. Now, last year, 45% of those surveyed thought the coming year, this year, would have rising property values. And in fact, the year before, 61% thought property values would rise. But this year, respondents weren't as confident of property values rising. Only 12.7% thought they would. About 20% thought properties would decline 0% or up to 5%, so a small amount. 23%, so a quarter of people thought there'd be a little decline, and a quarter thought there'd be a decline of up to 10%. Sarah, I guess they're reading all those negative Nellies and the property pessimists in the media.
Yeah, absolutely. And one of the things I just did, had a chat with someone last week, a journalist, about this, because the RBA modelling had come out and said that we could see a 20% decline. And I was kind of reiterating to him that a forecast is not the same as modelling. If the RBA is modelling that, they're saying this could be the worst case scenario, but they're not saying this is likely to happen. And we saw that happen a lot during, when the pandemic first hit, and a lot of banks did a lot of modelling. And I can remember in particular that 32% figure got thrown around a lot. They were saying it was either Westpac or CommBank economist had said that we're going to see, I think it was Westpac, we're going to see a 32% drop in property prices. And I got my hands on the report and I went through all the details and dug into the weeds of it to find that particular stat. And it was one very small paragraph buried on, page 42. And it modeled if A, B, C, and D happens, then we could see property prices fall up to 32%, which is obviously not what happened. And it was very misleading and reckless of the media at the time to jump onto that statistic without kind of giving it the context that it needed. And I think the same applies to this recent RBA warning, that we could see prices fall up to 20%.
Sarah, it wasn't even a warning. The media made it into a warning. You're right.
Yeah.
It was one of the many models. They look at the worst case, the best case, the most likely scenario, but the media doesn't tell us that.
Yes, it can be a little bit sneaky in the pursuit of clicks. So, and that comes back to that idea or that concept of having a long-term view, because realistically, even if that did happen and property prices fell 20% broadly, as long as you don't have to sell and you can withstand that dip in the market, long-term, you're going to be okay. So having that longer-term view is so important.
Having said that, the market has never fallen that much overall. Individual segments of the market have. In that difficult time we spoke about a while ago, in 2017-18, the Sydney property market fell 10%. But at the moment, everyone who wants a job's got a job. The economy's doing well. There's this cloud of negative consumer sentiment covering all the positive fundamentals. But when we asked people in the survey, what's your biggest stumbling block to purchasing another investment? Not having enough deposit was one, and difficulty servicing the loans, like you said a minute ago. Not surprisingly, 39% of respondents felt that rising interest rates had affected their ability to purchase another property, Sarah.
Yeah, so we've seen the cash rate increase from 0.1%, at the beginning of this year to now be 2.75%. And the buffer that banks assess your loan on is 3%. So we're almost at that 3% amount, which means we're almost at the real major stress point that people are going to have that big mortgage stress at. And that's probably what's going to see some forced sales next year, because if you've bought at the peak of the market, you didn't use a big deposit, and now your mortgage repayments are getting untenable, that's going to force you into a position of selling. But this whole situation just shows how bonkers this market is and these rising rates are, because the banks, when they had that 3% buffer, which was 2.5% and got nudged up to 3%, when they had that buffer, that was in place as like a worst case scenario. And this vision of it will take us years to get to this point, no one predicted. I mean, even you've been in this industry for decades. No one predicted that we were going to see rates rise this fast and this high. It is a really unusual situation, and it's going to be interesting to see what happens next year, because we did start to see economists already. At Finder, we go out to a panel of experts and economists every month. You're on that list. We always reach out to you for your thoughts, and we speak to a lot of bank economists and people who really know what they're doing and are deep in the weeds of all this research. And we're already starting to see some of them say that they believe we'll hit the peak of interest rates soon, and that we may even start to see interest rates come back again by the end of next year or mid to late next year. It's only a few saying that so far. Out of the 40, there's only a handful that are saying that, but it'll be interesting to see how that trend goes and where interest rates go next year. It's a really unusual situation.
Yes, it is. But if you're an investor, you've got rising rents protecting you a little bit, but home buyers, and there's no doubt that some home buyers bit off more than they could chew. They got in with low deposits, and some will even have a bit of negative equity at the moment. But home buyers are really loath to sell up their homes. They don't want to get back into the rental market. There's also an ego side of it. So, Sarah, in my opinion, they'd rather eat Maggi noodles than sell up their homes, and they're probably going to have to just budget a little bit more. But yes, some interesting times, particularly for all those who locked into fixed interest loans and are now in a sort of mortgage prison, because when they come to refinance their loans with their banks, as you correctly say, the banks are going to want to make them be able to pay 3% above what the going rate's going to be when they come out of their fixed rate period. And while that was an appropriate stress test a year ago, it's probably not appropriate now, because it's really, really unlikely interest rates are going to go up another 3%.
Oh, that's such a good point. I hadn't thought about that fact that serviceability there was to buffer us against future interest rate rises. But if we reach the peak of our interest rate rise run, we probably don't need a buffer that big. But I suspect it'll stay there. I can't imagine.
Well, they've lowered it in the United Kingdom, and I believe also in New Zealand, and it's likely they're going to bring it down but APRA's not in a hurry to do that at the moment. Now, we hinted a bit earlier on about the big surprise that almost 1 in 3 who owned an investment property sold one property, and others are considering selling. It was interesting where this was. So a larger percentage sold on Brisbane, Sunshine Coast, Gold Coast than other areas. And anecdotal evidence, having spoken to a few people, was, hey, my property hadn't performed for a long time and it suddenly did, so I took the opportunity, which is a little bit like what you said, and much the same in regional Australia. So 6.7% of the people who responded had sold a property in Brisbane, Sunshine Coast, Gold Coast, or 5.6% in regional Australia, fewer in Melbourne and Sydney. Also, interestingly, very few in Perth, even though the Perth market hasn't performed very well for a while.
Yeah, and I think also the interesting thing there is that around 2/3 of these properties were sold back to owner-occupiers, meaning that that pool of rental properties has been diminished again. And, we're in a rental crisis at the moment. We're trying to find a home if you're a renter is just, really, really difficult. And the price you're paying is skyrocketed compared to what you were paying 12 months or 2 years ago. So we've seen a whole bunch of stock removed from the rental market. And that's not a situation that's likely to change anytime soon. That combined with all of these weather events that have impacted a lot of rental stock as well, it's a really tough time for tenants, which is going to be even tougher if those 32% of people who own an investment property and they're thinking about selling, if they actually do sell and those properties go to owner-occupiers, it's going to make the rental market even tougher. So there's just so many different elements going into it at the moment. It's really quite difficult to consider where we might be. This time next year, if we were having this conversation next year, I think we'll have a completely different set of circumstances on our hands.
We will be having this conversation next year, Sarah, so it'll be interesting. But we also asked, how has inflation affected your household finances? Now, for the previous couple of years, we asked how COVID affected your household finances and your lifestyle. That's now long gone. And the bogeyman this year is inflation and rising interest rates. And surprisingly, 84% felt there was no real change to their household finances, Sarah.
Yeah, which, I guess that reflects also that the respondents to this survey, a huge chunk of them indicated that their income sits between 100,000 and 200,000 of their household income. And that is a really, comfortable financial position to be in. If you're sitting in that space, then you're probably not going to be too impacted by petrol prices going up and spending an extra $20 a week on your petrol, or, your electricity prices going up $100 a month. It's not ideal, but it's something that your budget can handle. That kind of reflects the fact that there was a higher income level of the people that responded to the survey. And again, I think it's the first home buyers who are going to be the most stressed by these cost of living pressures, because their mortgages skyrocketed and so has everything else. And then they're a little bit stuck because if they're in that negative equity situation, or if their property just, hasn't grown in value and they can't sell and move on, they could be a little bit stuck. But like you said, people are quite creative, and maybe it's just a matter of Maggi noodles for a few months to get through it. The other thing too is that banks really don't like kicking people out of their homes. They have a lot of hardship programs, which were very thoroughly tested over the pandemic, but they have hardship programs and policies in place to try to keep people in their homes as long as possible. So, I think we'll see probably an uptick in those policies being taken advantage of in the next 12 months.
But unfortunately, 34% of the respondents did find their financial situation had worsened, and that's a terrible position to be in. 12.6% had to cut back on groceries, and I wouldn't like to be in that position and my kids miss out. And 9.6% have actually cancelled a holiday. 10% cancelled a holiday. Now, that's not surprising, because I guess if you've got to cut out somewhere, that's discretionary spending. What about if the rising interest rates, would that cause them to sell a property? And the majority of people said no, but a small group thought they may have to, and we asked them what level of interest rate increase would cause that, and it seemed to be another 1.5% rise in interest rates. Sarah, that's if we're talking about 0.25% interest rate increases as we're getting at the moment, that's another 6 interest rate rises. I don't think that's going to happen.
Yes, I would be very, very surprised if we saw that level of increase. But I mean, in saying that, the last 9 months has really caught me by surprise as well. But, I think it would be remarkable to see our cash rate. Our cash rate would have to hit 4% or above. It would be remarkable to see that happen, next year, like over the next 6 months with all of these other things going on. Like, I just can't see that happening, but time will tell.
Well, we're hostage to some of the things that are happening overseas, aren't we? Now, we also asked, has rising inflation or higher interest rates changed your strategy or your approach to investing? And as we've already hinted a couple of times, Sarah, people had a long-term outlook, so it didn't change their approach much.
Yeah, exactly. 43%, in fact, said that they have not changed their approach. And that does make sense, because property investment should be long-term, where these wobbles and this volatility that happens along the way shouldn't make you change your strategy. It should make you revisit it and review it and make sure you're still, on the right track and headed in the right direction, but you shouldn't have a fundamental rethink. And, I think for a lot of property investors, I know that when I was starting out, many, many years ago, I did sell properties when things got stressful or when, I can remember selling a property because there was a huge water leak on it. And it was this 12 months of hell of trying to fix it, digging deep underground, trying to find the source of it. And it was so stressful that I said, no, I can't do this anymore. I don't want it anymore. Do I regret selling that property? 1,000%. I would be worth about another $700,000 right now if I had kept it. But at the time, that was the right decision for me because the psychology of owning it on top of everything else I had going on in my life at that point was it was just untenable to keep it. So that's why I just think that, I sound like a broken record, but when you have that long-term strategy, it serves as a little bit of an anchor point. And back then I didn't have a good strategy. It was a bit of a play and pray. Let's just buy property and hope for the best. Now that I have a better strategy in place, if that same situation kind of arose, I wouldn't be tempted to sell because I'd have my eye on the long-term prize.
Well, 38% of the respondents are similar to you. They are planning to buy an investment property in the next 12 months. Of course, this was down from the long-term high of 50% last year. And they saw, in general, Brisbane having the best capital growth opportunities over the next 5 years, followed by Melbourne, then regional Australia and Sydney a bit less than that. So Southeast Queensland seems to be the place to go. And when we ask them what sort of properties, I think we've got a reasonably informed audience. So clearly off-the-plan properties were out of their favour. We know there's lots of challenges with those, but respondents were keen to buy established properties, and in particular properties to which they could add value, I guess manufacturing growth at a period of the cycle when the market is unlikely to do a lot of heavy lifting.
Yeah, I think that's exactly right. It's a more sophisticated audience that understands that when the market has gone through a dip or when it's in a stagnating phase or a falling phase, that doesn't mean that you can't add value or that you can't drive profits from it. It just means you have to take a bit of a different approach, which I guess goes to my earlier thing. You don't change your strategy wholesale depending on the market, but you do review it. And, it might be the case that you have a property that could benefit from renovations, but that's happened to me in the past where this type of market happened and I went to my property manager and said, well, if I renovated the property, how much would that increase the rent? And that particular one, she came back to me and she said, it actually wouldn't in this market. You wouldn't get any more rent, but you would attract a wider range of tenants because at that time that property had some pretty down market tenants. And we decided not to renovate at the time because we had a tenant. We thought that's fine. Other times though, I've owned property and I've known investors who have done a quick renovation and it's added, $200 a week to the income they get. So that's why it's really important to revisit your strategy. But, taking on a renovation, especially at the moment, is a pretty big undertaking with all of these supply delays and, construction industry is just like backed up. So I wouldn't swing into that strategy straight away unless it was already on your agenda and you're just thinking, okay, now I'm going to move it up my timeline a little bit. But it definitely takes quite a lot of research to execute it well because renovations are full of surprises.
They are. And so there's quite strong anecdotal evidence that in the current property market for established homes, if it requires renovation, there are fewer purchasers interested in it. And if a property is actually fully renovated and all the work's done, buyers are prepared to pay disproportionately more. While a couple of years ago, people loved a renovator's delight just for the reasons that you've said. Now, we also asked the respondents, what's your long-term strategy? Because you keep talking about strategy, Sarah, as do I. But interestingly, 12% didn't even have a strategy, which is disappointing because buying an investment property is not a strategy. In my mind, the property you eventually buy should be the physical manifestation of a whole lot of decisions that you've made in the right order, including a finance strategy, an asset protection strategy, a long-term growth strategy, a rental growth strategy. But when we actually looked at what their strategies were, almost half actually were investing for long-term capital growth and a much smaller percentage for cash flow. And I guess that's the way, in my mind, property investment should be.
I agree. And back when I was the editor of your investment property magazine, I interviewed, dozens of investors every year. And I would always ask them, what's your strategy? And I would be surprised sometimes at some people who had 4 or 5 or 6 or 7 properties and they would still say, I'm just still kind of figuring it out. And I think that is quite a common thing. Like with property, you can kind of get into it. There's quite a low barrier to get into it in terms of your education. Financially, there's a lot of barriers, but if you've got the equity or the money to dive in, you can dive in without really knowing what you're doing. And you often learn through hard-won experience of making mistakes and, fumbling along the way. So for those people that did answer, I don't really have a strategy, and anyone who's listening along right now thinking, I don't really have a strategy, I think the absolute best thing you can do for yourself is to develop a strategy. And a strategy is just a $10 word for having a plan. It's like, what do you want to achieve out of property? Obviously, you want to make money, but there's so many ways to make money out of property. And I always say, look ahead 20 years and where do you want to be then? What do you want to own then? And then you plan and plot the steps you need to take to get there. But just kind of the idea, like you said, buying a property in and of itself is not a strategy.
So again, how do you get to that level? In my opinion, you should seek advice. And that's one of the questions we asked. And I'm always interested in the respondents' answers. And 31% said they'd seek advice from a property strategist or an advisor, because it's really hard to put a plan together and it's good to get external advice. But still, 29% this year's respondents said they were not going to seek advice on their next property purchase. Interestingly, each year, about a quarter of respondents just don't seek anyone's advice before making those really big investment decisions. And in my mind, that's a concern, because despite the significant amount of research material and information that's available for free, there's one thing you can't get from the internet, Sarah, and that's perspective. And that only comes from years on the ground. You've got to understand how to interpret the data, don't you?
1,000%. And there's also just some parts of it that I think no matter how much research you do, I mean, it has changed so much from when I started 20 years ago, where there was limited or way less information now. Now there's 1,000 forums and programs and so-called experts. It's quite easy to call yourself an expert without necessarily having the runs on the board behind you too. So I just think it's such a big decision to make. I would be wanting to use the most resources that I could to make sure I'm making the right decision. And the mistakes that you can make with property can really put you off track financially. So it's really worth making sure that you kind of, you arm yourself with the right information and the right experts to make the best decision for you.
Now, one of the facts that I found interesting, and it happens every year, is that 70% of the respondents were male. Now, that's interesting, and you can read whatever you want into that statistic. But Pam, my wife, says it's because males have been trained to do what they're told. but I'm not sure about that, Sarah.
Well, yeah, it is interesting. And I find, like, at Finder, we do every International Women's Day, we do a bit of a check-in around women and finance and what their decisions are there. And it's so interesting to see that women are becoming more and more engaged when it comes to investing. But there's still some work to do in terms of just getting that, I think men are more likely to have these conversations. They will chat with each other about how's your property going? What do you think of the market? It's less likely for women to have these conversations. So we need to make sure that it's accessible and available to more women so that they can kind of get involved and be more empowered to make these financial decisions.
Well, there's lots of data in this survey, so I'm going to leave a link in the show notes so you can go through all the information. But it's clear that this year property investing confidence still remains strong, and those who can afford to are planning to take advantage of the investment opportunities the housing market is currently offering us by buying another investment. And in fact, a small group are looking at buying a home as well. Again, that was down from last year. But our survey shows, again, as we've said a few times, the importance of having long-term focus, and the respondents were looking for long-term capital growth. And while I can see this year, as we said, there's going to be a number of hurdles, a number of economic challenges, I'm really pleased to hear that few have changed their long-term goals, because when they look back, as you said, this is just going to be another year. You've been around long enough. We've been working together for many, many years with you in your industry and me in mine, and we've been talking together. And every year has had its challenges, hasn't it? Every year there were excuses not to get involved in property, Sarah.
You couldn't say it better, I think. And that's why it comes back to that concept of when is the right time to buy property. It's kind of, it doesn't matter what's happening in the market as much as it matters what's happening with you personally. Do you have the financial capacity to buy? And do you have, looking ahead, do you have a plan and guidelines for what you want to achieve? All of those personal things impact your ability to successfully invest way more than whether interest rates are going up or we're in a whatever cycle we're in, whatever part of the cycle we're in. It's getting your personal ducks in a row that really, really matters the most.
Well, I really appreciate that finder.com.au, which is Australia's leading comparison website, joined Property Update in this year's survey, and I look forward to doing it again. So you also have a Finder Money app, which I found very exciting. Do you want to just quickly tell us about that?
We do. I love our app. Around 400,000 Australians are using it to just help make better financial decisions. It's just a little pocket-sized resource you can use to kind of manage your bank accounts. You can shop around there for better deals on your everything from your internet to your mobile phone to your home loan, and just kind of keep on top of the latest offers that are happening. It's a really useful resource. One of the great things that we have in there too is a credit score tracking. So every month it updates your credit score and tells you where you sit, which is really, really helpful, particularly for investors. I find it just ticked over at the beginning of November, and I always check in to see I went up, I don't know how, but I went up 4 points this month. It always makes me feel good to see it go up. But that's, a really nice benefit of the app as well, and it's completely free.
Well, I'll leave a link to it in the show notes. Thanks a lot again, Sarah Megginson, money expert from finder.com.au.
Thanks, Michael.
In a moment, I'm going to share my mindset message with you. But before I do, I'd just like to explain a little bit more about my thoughts with regard to the Property Investment Sentiment Survey, because it really shows how emotions have played a big role in people's decisions about what they do with their properties. Because the property market performed well over the last year or two, not as much in this last year, but in 2020 and 21, and property investors sold up. I guess we're experiencing a wild time in our economy and in our property markets and in the news and the media. And sure, decreasing affordability is causing property values to drop a bit at the moment, but that's not a reason to sell up your properties, nor is the media full of stories of property markets falling a reason to do that, because if you have a long-term plan and you have long-term goals and you've got a strategic property plan, you've got to accept that this is just part of the market cycle, that's ups and downs of property values, of interest rates and of inflation. So at times like this, it's really important to have a clear strategy and a plan and not be an emotional investor. The more prepared you are, the more you're able to take the emotions out of your investing, especially as many experienced economists are expecting our housing markets to turn early next year. You've heard in my podcast with Dr. Andrew Wilson about how asking prices are starting to even out now. They're not falling anymore. In fact, the end values of properties, the sale prices are also not falling as fast. We're going to reach a point where inflation will come under control and interest rates are going to peak. And at that stage, more and more people are going to get into the property market. But already smart investors are doing this. And I know my team at Metropole are seeing more clients and prospects than ever. We can provide you with a time-tested, proven frameworks tested by me and fine-tuned by me over almost 5 decades. We've invested in times like this before. And I'm going to show off again. I mentioned it a while ago. My team recently won a number of awards from International Finance Derivatives magazine as the most trusted investment consultancy company in Australia in 2022 and the best property investment consultants in Australia in 2022. And we won another award from Finance Monthly magazine, Property Investment and Wealth Strategists of the Year for 2022. So if you're still interested in property, whether it's your home or an investment, why not go to metropole.com.au and organise an obligation-free complimentary clarity consultation with Australia's leading property advisors, my team, to help better understand your options. Let my team help you. And remember, we've got no properties for sale, so our advice is independent and unbiased. It would be a shame not to take advantage of that opportunity. Go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to discuss with you the one thing that could make a huge impact on your life, on your future, on your financial future. Now, you may be familiar with this. It's a concept that I've got to give credit to for Gary Keller, who wrote an epic book called The One Thing. The essence is captured in what Keller calls the focusing question. Keller argues that the key to extraordinary success is focusing daily on the one thing. The thing that's most important to achieving a goal, rather than scattering yourself in many directions. Keller explains how to determine your goal or your life purpose and then focus intensely on getting there. In other words, avoid the pitfalls such as multitasking, relying on unprioritized to-do lists, thinking too small, misunderstanding willpower and discipline, and neglecting your personal life. Keller says that when you know and focus exclusively on the most important thing every day, everything else falls into place. Extraordinary focus on the one thing brings extraordinary success, according to Keller. And that makes sense, but I want to show you something different today. I'd like to ask you to consider the inverse of Keller's question. What's the one thing you do not do so that by not doing it, everything else ends up being more difficult or forever stays on your personal to-do list? Now that's scary, right? Sometimes we only look at what it costs to do something, and then when it seems too hard, we just don't do it. But when you turn it around and look at what it costs not to do something, we may find the price and the pain of inaction can be even worse. Now, I'm not sure what that would mean for you. Maybe it's being stuck in a job trading time for money. Maybe it's not having sufficient choices in life because you don't have passive income coming in because you haven't invested in property. Remember, you're never going to become rich if your money doesn't work for you while you're asleep. Or maybe it's just the frustration, the regret, or the envy for those who do have those choices and the passive income and have more. When you prioritize, so you're focusing on the right thing at the moment, everything after that subsequently seems to fall into place like a progression of dominoes. When you pursue your goal by starting with the one thing, the right thing, it leads to bigger things. You build energy. It's a geometric progression. To achieve success, I'm going to suggest you aim for the moon. Getting there is doable when you create that domino effect in your life. You see, a wealthy person doesn't become wealthy in a day. A champion athlete doesn't start winning on day one. Money, skills, expertise, and accomplishment, they're built over time. Success builds on success sequentially as you move from one thing to another until you reach the highest level possible. So work out what the one thing is you should be focusing on, but just as importantly, think about what the cost is to you, your family, if you don't do the one thing. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?